I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is our podcast right here from Phoenix, Arizona. And today we're going to be talking about credit, okay? We're going to keep on bringing to you, I think, great pieces of just credit information.
Yeah, because we talk to these borrowers every day, and it just always hits us smack in the forehead how important it is to talk about the most important and easy things for our borrowers to do to improve themselves when it comes to getting mortgages. And credit's a huge one.
Credit matters not just in mortgages, right? But your insurance quotes. Oh, well, just anything insurance related,
life
homeowners, right. Insurance. And gosh, what? Anyway,
right. Getting
car loans,
getting a job, even
getting a job. You're right. Some, in the lending business, we pull credit reports.
Yeah,
by law, loan officers, for example, have to have a credit report pulled.
I think you and I had to come up with like a side business. I don't know what it would be called, but it would be dads pulling credit for their daughter's boyfriends.
Right, boyfriend credits.
Just a boyfriend credit. Nice to meet you, young man. Yeah. What's your credit score?
Yeah. I
want to know.
I need to know your social and date of birth.
Yeah, that's right. If you have a 700, you can stay out till 11 o'clock. If you got an 800 credit score, you can stay out till midnight.
Yeah, if you can't do a lie detector, you might as well do this credit report.
I'm telling you, there's something there.
Not a bad idea.
Yeah. Okay. All right. So we're going to talk about credit. We're going to talk about the most important part from a consumer standpoint in terms of what's the easiest. So important can be a little bit of a different word or a confusing word, but when we talk about important, this is the biggest impact, easiest one that you as a borrower control.
Okay. So what Tom's talking about is that we're going to put up a pie chart. Okay. This is the different pieces of the pies, right? The pie chart, and each piece has a certain influence over your score. So there are 5 pieces that really make up or influence the score. And today we're going to talk about one of those pieces, and Tom's talking about the most important piece.
Right. And I think maybe we just focus in on what that piece is. And it is, what are we calling it? It's just calling
in the pie chart, it's referred to as the amount owed.
Okay. The amount
owed on your credit.
Or also known as the utilization rate.
Yeah.
Right? Mm-hmm. Okay. All right. So we're just, okay, go ahead.
Well, I'm just going to quickly go. The pieces of the pie are this. The amount owed, or the utilization, is 30%. 30% is the length of credit history. 10% is new credit. 10% is credit type. And 35% is the payment history.
Nice. Okay, so that makes up 100% of the pie. We're talking 30% of it, which is this utilization, what we're calling amount owed.
Amount owed.
Biggest thing. So if you have pencils, actually you don't even need pencils. This is so simple. So you want to just explain what we're talking about here?
Okay. If it's about the percentage of, take your credit cards, right? If you have a credit card, just to make for easy math, the credit card has a $1,000 line of credit. Okay. You can take up to $1,000. If your utilization, the amount you owe is $300, and on the credit report, that's 30% utilization. Okay. So the best scores come when the balances are below 10%. In fact, really below, like at 1% would be ideal.
Right. I think, believe it or not, zero is not the optimal, but they say 1%.
Yeah.
So try and get it to 1%. Probably very, very difficult. So Ed, what you and I always talk about is getting in that 1 to 10% range.
Yeah. And so people who are watching this, I mean, a lot of you who are calling us and are these borrowers, they're proud of their score, or they're proud of that. Oh, I don't have any credit. I don't have any debt. I pay off all my credit cards every month, all of them.
Well, you know what? Can we just take myself as an example?
Yeah.
I have pretty decent credit. Yeah. I have a couple of credit cards. I pay them on time, but my utilization is not very good. because I've got a big family. We have lots of expenses. So on a $5,000 credit line, and if I have 4,000 of it used every month going to Costco, that's an 80% utilization rate. So I probably have an 80% utilization rate all the time, which is not good. So
this is the trick, people. Like, this is the piece of the pie that you can control on a month-to-month basis. Those other pieces of the pie we're gonna have videos and podcasts about as well. But this is the one that you control the most month to month.
Okay, so how do they do it?
Okay, so Tom, let's take your scenario. You brought it up. Okay. I mean, if you have a $5,000 line of credit and you usually hold a $4,000 balance by the time the credit cycle is done.
Mm-hmm. Right. I'll just tell you, I have a credit card. It starts on the first of the month and it literally ends at the end of the month. Some credit cards are not, first day to last day. Some are mid-month to mid-month. It all depends. But mine happens to be first day of the month and it ends on the last day of the month.
Okay. So now I basically created this example. I'm going to put this image on the YouTube video.
Okay. All right.
Let's just pretend your cycle is what this cycle looks like.
Okay.
The cycle begins around the 12th of every month and ends around the 12th of the following month.
So what that means is when I get a credit card and I paid off the month before and I go to Starbucks on the 12th of the month, that Starbucks purchase will be the first item showing up on my credit card statement. That's when the credit card starts all over again. Yeah. So literally on the 12th, my Starbucks charge for $5.40 will show up as my first charge for that month. Yeah, this was actually this is a real. This image here is from a Capital One credit card. The cycle started November 12th, 2019, and ended December 11th. Okay, so every month it's going to be just like that. It'll be around about the 11th or 12th is when it'll begin and end. So what Tom's talking about is exactly that. Like November 12th, you bought coffee. It shows up. It's the first thing that you bought. That's right.
Okay,
that's right.
And by December 11th, you have $4,000 racked up on the credit card.
That's right. That's right.
So here's what happens: the credit bureaus or the Capital One, all your creditors, all your credit cards are reporting those balances on December 11th in this example. So it ends. They
actually take a picture of it, not literally, but figuratively, they take a picture of it and send that to the bureau. So at the end of every cycle, they're taking a picture of what your balance is and they send it off to the bureaus.
Yeah, that's right. So you're looking at your statement, look at those dates, the beginning and end, the ending date. And I know Tom and I, we constantly have to remind ourselves too. I mean, it's the ending date. That's when the bureaus get the information. That's when they get your balance. So
Okay. So come the 11th, my 4,000 is very typical. Now, when it comes to my due date, my due date is typically 2 to 3 weeks out. So by call it like somewhere in near Christmas, my actual payment would be due.
Right.
And that's what I usually do. I usually wait a day before it's due. I go online, I make a payment.
Yep.
And I do that every month. I've never been late, God willing.
Yeah.
And won't in the future. But anyway, okay. So
99% of people do the exact same thing. With my due dates, whenever that comes, that's when I'm making the payment, right? 99% of the people are doing that.
So the good news is they make their payments on time, but the bad news is they always have reoccurring high utilization.
Right.
And what we're talking about today is let's change the behavior a little. Let's pay not when it's due, but let's pay, what do we say here? A few days before the actual end of the cycle. So before that 12th.
That's right. Before the bureaus get that balance from your credit card company, pay down the balance a couple days before. So the key is in this particular credit card cycle, since it ends December 11th, I would want to make my payment on this credit card balance about December 7th. eighth,
Yeah.
something like that.
Seventh, eighth. Okay. Now, how much are they making it for? They haven't yet spent all the 4,000 that they typically do. Don't worry. This is not rocket science. We don't have to be exact.
Just put whatever your balance is. If you see that you have a balance of $3,500, send $3,500.
Yeah, just go ahead and send it over. Now, you'll still have a few days to rack up some additional debt on that credit card, but it'll be far lower than what it would have been if you would have just keep doing what you're doing.
That's
so the whole point is just simply move up the date at which you make your payment.
That's right. So for a lot of people, I mean, they don't have the ability to have a high credit limit. So if you had like a $50,000 credit line on a credit card, those folks don't have to really worry about credit utilizations. But that's unusual. Most people have, 5,000, 10,000, or 3,000.
Yeah.
So people should know what their line is.
Yeah, I guess that would be one benefit. Never thought about this. It's a good point. One benefit to increasing your credit line is so that you have a perpetual lower utilization rate.
Yes. So the one thing you could do in your scenario is contact your credit card company and say, hey, can you bump up my line?
Right.
Okay. That's one idea.
Right.
But you still can do this, and everybody, really should. And again, you could just put it on your calendar, a recurring event. Like if this was your credit card, you would say pay that, on this, the first week, the 7th of every month or whatever it would be. But again, folks, if you're, some people are they really want to get their scores in the 800s and they're in that 760s, 750s. That's how you get your scores in the 700 and then in the 800s.
In the 800s, right. And don't worry about making a payment even too big. Your credit card company knows where you are. Your credit card company knows what your account is, and they'll keep a credit on there for you. So the important thing is just make that payment. And even if it goes negative, I guess there could be a negative balance.
Yeah. If you overpay, it just is a credit towards your account. So it's great. There's no problem.
Yeah. So, okay, well, hopefully that hasn't been too complicated, but this is something totally in your control that you can set up. It's awesome. It makes huge impacts. If we had to guess what it did to our credit scores, I mean, it changes 10, 20%.
Oh, yeah.
I'm sorry, 10, 20 points.
Yeah. I mean, it's a huge piece. I'm just calculating right now. It could account for potentially, it could be 100 points.
You think that high? Probably
at 35%.
And it probably impacts the first-time home buyers a little bit more, where they have a little bit limited credit. So a bunch of their credit's based off of these cards, and if they have 2 or 3 cards with high utilization, that's a lot different than someone who's had credit for 10, 20 years and has 18 lines of it. So.
Yeah, that's true. If you have a lot of credit cards, the mathematical equation, the algorithm is looking at all of your credit together, what the utilization is.
Right.
But a lot of people, if you just have one credit card, that one credit card can affect your score greatly.
Yeah. Awesome. Well, hopefully this helps everyone.
So this does not have to do with installment loans. Okay. This is credit card revolving. Okay. That's something important. It isn't if you have a car loan, student loans. What else, Tom, is, any of these, Home Depot. Well, no, Home Depot, would be a revolving account unless it's just like, construction, you just get like one of these constructions. But again, personal loan is an installment loan. We're talking about credit cards, revolving credit.
Just revolving. Yeah.
That's what this tip is for.
Okay. Awesome. Well, you ready to call it a day?
Call it a day.
All right.
Everyone, have a good week.
All right.
Go look at your credit cards.
That's right. Get those paid early. Let's go home.
See you, everyone. Hey, guys. Thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to tom@azmortgagebrothers.com or yours truly at eddie@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.